It's one of those days, I think, after you get a big kind of volatility shock like we had last week. Looking this morning at the Dow down 200 or 300, you say to yourself, yeah, that makes a lot of sense. We're giving back some of yesterday's 550-point gain. Ending up flat or even in the green would have been like, yeah, I get that, because we're in this zone. We're still bouncing from oversold conditions. So that's the way the market tends to behave when you are coming off one of these nasty skids. I do think you could look and say, yes, the banks held up well, but there were more stocks down than up. You did see sort of tech not able to completely get any momentum behind it. I don't think today really changed anybody's mind, bull or bear. We're in a zone where we can kind of play around a lot before we get up another 2 or 3% in the S&P 500. That's really the next test. Inside of that, I think it's just stuff bouncing and reacting to earnings.
And Stephen, I guess small caps suffering still, and they've had a bad couple of days in general.
Yeah, I think the biggest takeaway that Mike was just talking about was the tech bounce yesterday. So I don't know if anyone changed their mind today, but they definitely changed their mind yesterday with that tech bounce. As long as we hold these gains in the market, as long as we're flat, to Mike's point, that's an overall win for the overall market right now. Tech has to hold in. That's the key going into year end. If tech can continue to bounce or move sideways, that is a tremendous win. As long as we stay above the 200-day moving average in the S&P, that's a look that everyone sees to see if we break down.
Market staying flat is an overall win, Stephen, just for this week, given last week, or for the rest of the year? Is that what we can hope for? No, I'm sorry. So today, after that big move yesterday, is a real win for the overall markets, because that Netflix sort of opaque view going into it, and then the extreme bullishness coming out, that's a huge win for the bulls.
You know, if you look overall at earnings, FactSet is pointing out, Mike, that there is a 90% beat rate right now on the earnings front. So most companies are beating, but only 50% of them are having positive share price reactions.
Yeah, I mean, look, the earnings themselves are coming in hot once again. It seems like the front end of earnings season, we actually do start to really overachieve when it comes to those beat rates. But, you know, this has been something you could observe all year, right? I mean, coming into this earnings season, the S&P was up a couple of percentage points. Earnings were up 20-something%. We anticipated a big gain in earnings, and I do think the market's struggling with, it's all about, in the next 3 or 4 quarters, is this cycle peaking or not? That's really the whole question for the markets. If your answer is no, if actually this growth continues, not earnings growth at this pace, but
signals.
Economic growth.
It's hard to tell.
Right.
I mean, ISM's over 60 is not late cycle.
That's right.
But on the other hand, you know, there are a lot
If we carry through next year and the Fed doesn't have to get aggressive to really put on the brakes, then I think this market is probably a buy.
And I think that's it. It's rates and it's tariffs. So, and they jockey back and forth on investor sentiment polls, which one is more important. And right now, I think it's the rates issue has taken center stage. And if we look at rates tightening, if we look at 50 billion unloading, we talked about that. If we look at 50 billion unloading per month now, the Fed unwinding their balance sheet, and then they have to sell more to cover the tax cuts. It's a trifecta of rates pressure going higher.